Hey, welcome to 2026, everybody. It's good to be here with you for Condors, Calendars, and Butterflies. My name is Brent Moores. We do this each Friday. And lately, we've been doing a series on just exploring different strategies. Today, we're going to hit up another one called synthetics. So we're going to be doing that coming up in just a minute. But first, let me mention a couple things. One, glad you're here. Whether you're watching live or on a recording, that's great. Either way, we're just glad to have you. Number two, I'm joined by James Boyd in the chat. Appreciate James for helping me out. As you have questions, feel free to type those in the chat. Between James and myself, we'll do our best to keep up and help you with your questions there. You can also follow us on X at Brent Moore CS, at James Boyd CS. Also, make sure you check out James's webcasts throughout the week, including his Investing Master Series, which is on Tuesdays at 11 o'clock Eastern Time. So there we go. Hey, let's hit up the disclosures real quick, and then we'll get to looking at some more investing stuff here. Options do carry a high level of risk and are not suitable for all investors. And this material is intended for general, informational, and educational purposes only. With long options, an investor can lose 100% of his funds invested. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And the paper money software application is provided for educational purposes only. Incidentally, that paper money application will not assign options early, so that's a difference between paper money and your live platform. Just be aware. Be aware of the trades, the risks, and the transaction costs, which I probably will not go through today on these, but just realize there are transaction costs when you trade. And investing involves risks, including the loss of principal as one of the potential outcomes of that. There's no guarantee that an execution of a stop order will be at or near the stop price. And past performance is no guarantee of future results. Schwab does not recommend the use of technical analysis as a sole means of investment research, but we will use some technical analysis. Even if it isn't your sole means of investment research, we do that each time. Okay, hey, we're not finishing off the year. I guess we finished off the year. We're starting the new year, but we're still kind of this holiday period right now. I still kind of consider this, I think Monday is really where we're kind of kicking it off, really, in terms of the year. Hey, we're down a fifth of a percent today on the S&P 500. Kind of not a strong finish to 2025, excuse me. But it is, we'll see what the next year brings. But even though we've had some down days, it doesn't mean the trend's been broken, right? I mean, we're a little bit below the 20-day moving average, but really we've had, I think the market's been trending relatively strongly for quite a while now, and it may not have let up. In fact, we most recently hit an all-time high just about 5 trading days ago, okay? So that means a lot of stocks are probably doing fairly well right now. And in fact, I thought I'd look at one. Let's look at Bank of America. Bank of America looks, pretty similar, I guess. Higher highs, higher lows. If you're thinking of investing in the stock, okay, forget options here for a sec, just the stock. If you're thinking of investing in the stock Bank of America, there's some things you're going to be aware of from a technical standpoint, the trend, maybe the moving averages. I have a 20-day, 50-day, I don't care what moving averages you use. In fact, I don't care your exact technical analysis approach as long as it makes sense for you and hits the fundamental parameters that you're looking for in terms of technical analysis. Trend, support and resistance, stuff like that. Bounce off the 20-day, that's a decent sign. No huge resistance, it appears. Trend is good. Momentum looks like with the bounce today, nice upward momentum. We're a little bit up over 1% today on this, so outperforming the market. And we do have earnings coming up. This is one of those financials, so it'll kind of kick off earnings season. But hey, if you're investing in a stock for more than, a couple months worth of time, you're probably going to bang into earnings at some point anyway. So that's not a disqualifier. You can trade over earnings. And in this case, here's what I want to do. Let's go to the Analyze tab. I'm going to pull up Bank of America. And let me just pull up the stock here. And let's go to that risk profile. That's what the stock looks like, okay, on the risk profile. I know we use this mostly for options, but for our purposes today, let's just look at this for a stock to start out. This is, for those of you who aren't familiar, this is the profit or loss. So this would be break even at zero. This would be a $500 gain. This would be a $1,000 loss down there. This is where the current price is. If you buy a stock and it goes up, hey, lo and behold, you make money, right? If you buy stock and it goes down, you lose money. That's how that works. This is the underlying price of the stock right here that we're looking at right there, okay? So that's how we can look at that stock. But you may go, well, let's consider an option here. So you can go, well, I'm going to go out, this is going to be more of a trend trade. We kind of established that already. I'm going to go out to March, and I'm going to go about at the money, $55 stock. Let's do the $55 strike. I'm going to click a long call on here. And just for our purposes right now, I'm going to click on a short put at the same time here, okay? Let me go to the risk profile. Let me just kind of get rid of some of this. That was the stock, just to remind you. Here's what the long call looks like, and you can see the differences there. Some of the differences, this part kind of looks pretty similar. If the stock goes up more, you make more money, but then it kind of flattens out here. You lose, you cap your losses out. But one of the big differences is, remember, this is where the stock currently is. I need this thing to move up a fair amount before I even hit break even, because this is my break even point. Well, look what happens when we throw that short put in there at the same time. Just get rid of that and move this up. And I'm going to just check on that short put. Now, this is what it looks like. Does that look familiar? Okay. Does that look familiar already? So in other words, if I do the stock, here's what the stock looks like. It's a little scrunched up there, but that's what the stock looks like. Here's what buying the long call and selling the put looks like. It's almost identical, okay? So from a reward to risk standpoint, this is very similar from the reward to risk standpoint to buying a stock. That's why they call it a synthetic. A synthetic, synthetic is like a substitute for something, right? Well, that's what it is. Now, it's not buying the stock. There's differences between the two. Stocks don't expire. This trade down here that I have is going to expire March 20th. Okay, that's a difference. Bank of America pays a dividend. Are you going to get a dividend if you do this trade? No, you're not going to get a dividend if you do this trade. So there are differences. Here's another difference. Look at the initial cost. If I buy 100 shares of stock, okay, we're looking at about 100 delta here on this trade right now. 100 delta. If I buy 100 shares of stock to achieve 100 delta, and the stock is at, what do we say, 55.71, this is going to cost me $5,500 or thereabouts. If I do this trade right here, how much is it going to cost me? It's going to cost me about $100. So $5,500 or $100. Now, that sounds great. Hey, I'm only spending $100. If the stock goes up a long ways, I can turn that $100 and still make a similar amount of money as if I put down this big investment. That's a nice thing. But also keep on the down, keep it real here. On the downside, if the stock goes down, you can lose money just as fast as if you spent the $5,500 on the stock. It's like buying a house in this. This is just an analogy. It's not the same as buying a house, but if you have a mortgage out, you put a certain amount down on the house, and if the house goes up a lot in value, it can make your investment seem pretty good from that standpoint, in that you put not that much money down, but you made a lot more. But if the houses go down in price, you can get underwater very quickly. Same thing with the synthetic here. And so that is a long synthetic. All right. Now, I specify long synthetic because there's different types of synthetics. All right. There's different types of synthetics. A long synthetic is supposed to simulate, and we talked about some of the differences there, buying stock. You can do a short synthetic too. Okay. And in fact, let's kind of just jot this down. Let's kind of just write this out. Actually, before we do so, let me just mention a couple things. The delta is going to be pretty close to 100 on these typically. Okay. There's your delta. Notice your theta and your vega. Yeah, there's something there, but they're really small, very minimal. Okay. So one of the challenges we have week to week as we look at these different strategies is, we're going kind of trying to go, well, what's volatility going to do? Is implied volatility going to go up or down? How's that going to affect the trade? It's kind of a complicating factor. In this case, it's not that much of a complicating factor with implied volatilities or time decay, because they're really going to be pretty minimal there in this case. So let's do this. Let me go and just kind of write this out for you real quick, and then we'll get back to what we're talking about here. But first of all, what I just described to you is a long synthetic, okay? So we're going to do a long call, and we're going to do a short put, okay? And they're going to be the same strike and the same expiration. So that's a long synthetic. I alluded to, although I didn't show you, a short synthetic, okay? That's going to be a long put and a short call, okay? And this is going to have a theoretical unlimited risk. This is meant to simulate shorting stock. Well, shorting stock, you have a theoretical unlimited risk on that. Okay? So that's why. And it's not something I'm going to focus on today. I'm going to focus on long synthetics today, but you may hear that. I've shown them before in classes, in webcasts, short synthetics, but I want you to be aware of the risk. There's a theoretical unlimited risk. It's also going to take a higher option approval level on that, and more margin required on that too. Okay, so those are the things. Incidentally, by the way, are there other types of synthetics other than that? Yes, and you may not be aware of that because we don't talk about them, and I don't ever demonstrate these. But you could do a synthetic long call. Now, remember, this is synthetic stock. Can you do a synthetic long call? Yeah. If you buy stock, do long stock and buy a put at the same time, and you compare a long call with the long stock and the long put, you compare those risk profiles, they're going to look very, very similar. Okay. Very, very similar, just as I showed you the similarity between buying stock and doing this long synthetic looks like. Okay. Could you do a synthetic long put? Yeah, you can do a synthetic long put, short stock, and do a long call. Okay, do it at the same time. You're going to come up with a synthetic long put. There's others as well. I'm not going to spend the time going through them. I don't see them as, for most people, an integral part of their portfolio. So just be aware of that. These are directional, and they're going to be. We'll say close, near 100 delta. I'm talking about long synthetic. Obviously, if you're doing a short synthetic, the delta would be near negative 100 on there. Okay. Widely said, short synthetic, you should buy a call for. Yeah, you can do that. And so this is a good point. I said, well, look, hey, there's this kind of theoretical unlimited risk on this. I'm glad you brought that up, Wiley. Is there ways to kind of protect yourself? Well, yeah, like just similarly, if you buy a stock, okay, talking about long synthetic here for a sec, if you buy a stock, you may consider putting a sell stop on it to try and protect. Could you put in an extra, but could you put in some sort of protection by, well, obviously we'll put exits on these regardless, but you may also buy I guess the analogy would be if you buy a stock, could you buy a protective put on the stock? Yeah. Could you buy an extra long put out of the money on this to help protect? Yeah. Or could you buy an extra long call out of the money on this just to try and protect it? Yeah, you could do that too. So I appreciate your point there, Wiley. That is certainly possible on that. Okay. So just remember though, this is not stock. Okay. And I gave you a couple, it's leverage, more leveraged, expiration. There's an expiration on it. There's no dividends. Okay, so just don't confuse those things. They're theta and vega. I'm going to say neutral. I mean, as you saw, they're not exactly zero, but they're certainly minimized significantly. How long do you buy? What expiration date? You buy as long as you expect the trade to last. Okay. So in our example, when I was looking at Bank of America, I was kind of expecting this kind of trend trade. So I bought out a couple months, right? Because I'm expecting that trend to go to maybe 3 months or whatever. Could you do a leaps synthetic if you're doing a long-term trade? Yeah, you could do that too. You're just going to buy more time. And one of the nice thing is if you go out further in time, because both the call and the put are both going up in value, they still can kind of cancel each other out, and your initial upfront cost may be relatively low there in that case. All right. Okay. Typically at the money. Okay. You can go in the money, out of the money a little bit, but typically they're at the money. Okay. Upfront cost often near zero. Okay, we talked about that. Let's see. Since it moves like a stock, we're going to manage it like a stock in this webcast. So in other words, how do you manage stock? Well, maybe if you're doing a shorter term trade or you have a price target, you would get out if you hit the price target. Maybe if the stock drops below a support level, a key support level, you would perhaps exit that stock. You could do the same thing here. In fact, we'll give you an example of that as we go. And then let's see. So we're going to set stop loss. Okay, I don't know why my margins, my tab just went over a little bit, but I'm not going to worry about that right now. We're going to exit on a technical breakdown. Okay, so if we're bullish and we're doing a long synthetic and we turn bearish on this because our technicals go south on us, we're probably going to get out. We can set a target. And let me think, I just have a couple more I jotted down here. We're going to, exit near expiration, if nothing else. This does have early assignment risk, as anything with the short put does. And then, use your money management. And for our purposes, we're going to say 1 to 2% of active trading portfolio. Okay, so that's it. Those are the kind of basic guidelines we're going to do. Now let's go and set this trade up. Let's just submit this trade here on this. So that is, we did this March 20th, $55. Let's go back here for a sec though. Okay, so here's the trade tab, and we said how many days? I got March here. March 20th is what we were looking at there on this, and I went about at the money, 55, and you can see the cost of the trade. The calls are going to cost more than the puts here. So in other words, it will be a debit when we do this trade. If this side, the put side, was more expensive than the call side, then we'd be a little credit, okay? But in terms of overall price, just remember, instead of $5,600, it's going to be the difference between those. If I want to do this trade, I can click on the ask price. I can do a control click on the bid price and say, when do I want to get out? Well, that brings us back to our technical analysis. I'm going to say this. I'm going to say, hey, look, we have what I would deem to be kind of a support level here. We bounced off this level, kind of bounced off it. We broke through it, bounced off it on the high side, and I'm going to consider this right around there, about $54 to be a support level. I'm going to put a stop down here closer to that 50-day moving average, about 53.5. So on my trade, what I'm going to do is, I'm going to go first trigger sequential. I'm going to right click on this. I'm going to create an opposite order to get us out of this trade. And I'm going to say that's going to be a market order, good till canceled. And we're going to click on the gear and we're going to say we're going to get out if Bank of America marks less than or equal to, and we said 53.5, 53.5. Okay, I'm going to save, and then I'm going to click on confirm and send, and we're going to look at this, okay? Because you should read these, okay? You should read these before you make sure it makes sense. I'm buying this, I'm selling this. It calls it a combo. Combo is just kind of a generic term it uses, but this we know are synthetic. We're exiting if Bank of America marks at or below 53.50. I'm going to put this in my long stock synthetics bucket there and send that trade. Okay, hasn't filled yet. If it doesn't fill later, I may nudge it a little bit, so to speak, to get it filled. Okay, let's look at another one here. How about? So let's do one that's a little bit longer term. Now you can go and, how did I find these? I just looked through a list of liquid stocks. That's most of the time when I'm looking for trades as examples in this webcast, or just trades I want to see, even if I'm not doing a webcast. I just look through a list, especially if they're options trades, potential options trades. I'm just looking for more liquid stocks. Well, look, liquid stocks don't guarantee a liquid option, but it's a good start, right? If the stock's not liquid, I can almost guarantee you the options aren't going to be liquid. So that's the first thing. But just because you have a liquid stock doesn't mean you have a liquid option. Okay, so I can give you other examples. Here's one that I looked at. This may not be the best example because there's probably better examples you can do on this. But hey, look, we've got Lam Research, and if I go up here, it's trading 6 million shares today. Market's not closed yet. It's still going along. Obviously, a lot of trading here, but if you're going out, you may start to look and go, well, those spreads are a little bit wider here. Or you can go to your open interest and start to look, and that's actually not too bad. But as you go out farther, what you may see is, and this still isn't that bad, but you start to get these wider spreads here on this. And so, you may decide to look for more liquid stocks here. I'm going to pull up one. Here's Merck. Okay, pharmaceutical, right? It's had a nice little run. We're doing the same thing in a sense of I want something that is strong from a technical standpoint. Okay? Now, this is a pharmaceutical. So in addition to the technicals of, hey, look, I think we kind of have a a level, that a resistance level there that we broke through, kind of bouncing off it right now. We're up today, some upward momentum. We're above our 20-day, above our 50-day. But look, if you're looking for something longer term, maybe you go to the fundamentals page and maybe you look at other things to see if you're more bullish on it. Now, what some traders will do is they'll say, hey, look, I want maybe an outside source to help confirm my feelings. So they'll look at things like analyst reports. Now, this isn't a recommendation to use any analyst report, but I'm just saying that's an approach that some people use, okay? These are all third party. They're not recommendations of Schwab. You can also go down here and you can look and see, you can do your more fundamental research if you're doing something longer term. Obviously, for a pharmaceutical, it's going to partially come down to like drug pipeline and stuff like that, and approval levels and things like that. But it also has things like, reimbursements, Medicare type reimbursements are a thing, right? Just national drug policies and thing. So that is, those are all considerations there. But if we're doing something longer term, you can go out longer term if you want, right? You can go out, well, let's go out December, okay? So a year, let's go out a full year on this. It's going to be more expensive. Well, it is going to be a little more expensive, maybe, just depends on the strikes we do. Stocks at 105 and change. I'm going to go to the 105 strike. What's the difference going to be? Well, it's about $12 there and about $10.50 here or so. So it's going to cost us a little bit, maybe a couple $100 or a little less probably. But how much is 100 shares of stock going to cost? $10,500. And so let's talk just a little bit more broadly about when you would do these. Why would you do a synthetic instead of just buying the stock? Or why would you do a synthetic against other choices? One thing is this. A lot of times when we talk about potential types of option trades, we do this each week. When we talk about iron condors or butterflies or whatever, we talk about the delta. My delta on this is going to be about 100, okay, roughly 100. My delta on a calendar isn't going to be 100, anywhere near there. My delta on a butterfly isn't going to be anywhere near 100 either, probably. Well, what about just a long call? Sometimes if we wanted something, a little bit more aggressive, we'll do a long call. Well, you could buy a in-the-money call that's probably close to 100, but that's not typically what we do. Typically, in this webcast at least, we're buying deltas that are in the 50 to 70 range or something. Okay, and so that's that's something you gotta think about here on this. Okay, now, good question. Okay, Marzina. I don't know if I'm pronouncing your name right. I apologize if not. Says, there's kind of a gap here between our bid and ask. Is that a concern? It's a concern, but let me give you a different perspective as well on this. Right now, we are 350 days out till expiration. I'm planning on holding it for a while. This is going to be substitute for a long-term hold here. As we get closer to expiration, we should see, I can't guarantee it, but we should see that open interest increase, and we should see those spreads tighten here. Furthermore, what I'm going to plan on doing is I'm not planning on buying hopefully not at the ask price. Hopefully we'll be able to get something closer to the mid price on that. Okay, hopefully something closer to the mid price on that. So it's a rightful concern you have there on that, but I think it's not such a big issue that it's necessarily going to keep us out of the trade. Okay, so question. What is delta? Delta is how much the trade is going to move given a $1 move in the underlying stock. Underlying stock goes from 105.88 to 106.88. How much money would we expect to make if it goes up, or lose if it goes down, on the underlying trade? If I do a trade that has a say a 20 delta or something like that, then that would mean if it goes up a buck, then I'd be making about $20 for the whole option trade, right? If it goes up a buck and I have something $100, I'm making about $100 on this. Or if I buy the stock and I have 100 shares and it goes up a buck, I'm making $100. So it tells you how much movement we're going to get out of that option, okay? So it's not a good thing or bad thing. Obviously, if I knew the stock were going to go up, without a doubt, then I'd just crank up the delta, right? But we don't know that. We may be wrong. The delta may go down. I mean, the stock may go down. And then you're losing more money quicker on the downside of things. But the whole assumption here is, hey, we're bullish on this. So I'm going out longer term here on this. I went out almost a year. And I'm going to go kind of at the money. 105 is the closest we're going to get. I'm going to click on the ask price. I'm going to hold down my control key. I'm going to click on the bid price. Here we go. Mid price is about $1.50. Okay. It's about $1.50. And I can put in a stop, right? We can do what we did on the other one. If this is a longer term trade though, I'm not going to have a super tight stop, right? If I'm planning on holding this, I don't want like a little wiggle down below a support to get us. Now, would a stop down here make sense? Probably, yeah. If it's going down, if this is a longer term bullish trade and I'm breaking down below 95, I'm breaking below a significant support level here, that probably is a problem. So that's how I'm going to view that. Okay, so I'm going to put in a stop, but I'm going to do it that way. Okay, so let's do this. Let me go and let's do the trade. Now, well, yeah, let me do this first. And we said below 95, I think. Let me create an opposite order. Market, GTC, gear, Merck marks less than, we'll say 95. And then save, and I can send that. Now, right now, it's showing 150. Let me move this up and I'm going to move it up a little bit to see if we can get filled on that. Okay, so we got filled on that. If we go to the Analyze tab and go back to Risk Profile and have Merck here, this isn't a simulated trade. This trade is actually in our paper money right now. And there you go. It looks kind of similar to that. If we had, I'm not going to take the time to do it, but if we looked at the graph of Merck stock, if we bought 100 shares of Merck stock, it would look pretty much the same thing. My delta, near 100, right? Okay, delta near 100. Theta, small. Vega, small. We'll let it run. We're going to manage this just as we would a stock. Now, Debbie says, will we move that stop up? Yeah, we'll move that stop up, just like we would a stock, right? If you put a stock on a stop, we'll move the stop up as the stock goes up. We won't move the stock down, but we'll move the stock up as the stock goes up. Or even if the stock doesn't move up, there's times where we may just say, well, this kind of just, our forecast is pretty bullish, but it just kind of goes and lingers down quite a while. We could possibly move the stop up at some point, but for now, we're going to let that go, okay? And by the way, I teach a webcast called Managing an Options Portfolio on Wednesdays. It occurs at noon Eastern time on Wednesdays. And we very often we'll move up stops in that webcast. And, that's great. We'll do that. So we'll keep an eye on that. Now, let's go back to, we had our trade on Bank of America. It hasn't filled, right? This was something I put in. It didn't fill. I'm going to right click on this if I want it to fill. So I'm going to cancel and replace this. This is just going to take this was our initial order right here. Click on this and you can see, well, look, it's the price right now. Let me just expand that out so you can see it, is 109. That's actually below the mid price. Okay. We're not going to get filled on that. Okay. Now I can move it up to the mid price, and in paper money, I may get a fill. In real money, it would be pretty unlikely you're going to get a fill at the mid price. Okay. But I'm going to move it up a little bit to something where it's maybe a little bit more simulative of actually getting filled here. And then if I confirm and then send this, it still isn't filled, but we'll see. I may, I didn't mean to do that. I may adjust this later and see if it fills later, okay, on that. Now, there's others we can do. I'm not going to just keep on going through examples here, but I'll look at some stocks that maybe you could consider in your paper money account if you wanted to, and discuss some of those. But another thing I want to do is I want to follow up. I don't want to run out of time. I want to follow up on, we didn't have a webcast last week. We didn't have class last week. We did 2 weeks ago. I want to follow up a trade. We only got one trade in a couple weeks ago. I wanted to follow up on that and just on management. But to my prior point of that managing an options portfolio class where I manage these trades, sometimes I manage them in this webcast too, just because sometimes you're not able to make the other webcasts. And this is the only one you see, and I like to look back at those. But if you really want more in-depth on managing trades, I'd encourage you to check out that class. Okay, enough said on that there. Let's look at another one, okay? Here's Schlumberger, okay? I was looking at this and went, well, hey, that looks pretty bullish. I got a nice big candle today. I mean, up almost 5% today, okay? And then, of course, very often, same industry group, Halliburton, kind of the same deal, right? Looks pretty, those charts similar. Oh, by the way, I'll go back to those in a sec, but I looked at Bank of America. Well, we already did a trade on Bank of America. I could have done a trade on Citigroup. Looks very similar. Well, same industry group often have the same, kind of the same feel, same look. Not always, right? Sometimes they go opposite directions. But those are some where you could certainly look at that. So, hey, Riceburg said, can you leg in to create it? Yeah, you can leg in, no doubt. You can leg in any, I mean, you could do a butterfly. You can leg into a butterfly eventually or whatever. It's not as common probably, but absolutely you can leg in to create a synthetic. Let's look at just some other examples here of trades that possibly you'd look at a synthetic on. Here's ExxonMobil, okay? All right. Here's, it's been doing fairly well. Okay? In fact, Eric and Chet said, what's crude oil doing? Well, let's do this, okay? I'm going to bring up a symbol of a future, but we're not going to be trading the future. This is just simply to look at the price of oil. Look at what the price of oil has been doing, okay? What has the price of oil been doing? So it's been going down. Well, actually, so you may go, just kind of, well, ExxonMobil is going to be going down too. No, ExxonMobil is actually held up pretty strong. So from a technical standpoint, we have higher highs, higher lows. We're above the 20-day. Nice bounce today. Of course, there's risks to the company. I didn't even look at Chevron, Texaco or something. You could look at that. I suspect it probably doesn't look that different. That's another one you could consider a long synthetic on. What about a short synthetic? Just remembering, going back to the examples that I gave you earlier, remember a short synthetic is long put and short call. Long put, short call, remember the risks there. But what would I look for on something like a short synthetic? Well, maybe something from a technical standpoint that may look more weak. Maybe this represents the very low and it's just going to turn around from here. I don't know, but if we're trading the trend, this has been a poor trend. We seem to be bouncing off that 20-day again, and Not a pretty chart. Okay. Another one I looked at, well, let's do Netflix, NFLX. Paper trade them. Paper trade a synthetic, folks. Paper trade a synthetic. Don't go out and do real trades until you're comfortable and ready. But right now, paper trading doesn't hurt there. There's another kind of more bearish example. Was looking at, by the way, at another bullish potential example. I found this one was kind of interesting. We already have a trade on this though, so I didn't want to duplicate and do a lot of trades on the same stock. CMG was one of the worst performing stocks. It was one of the worst performing stocks of the year. Okay. Chipotle Mexican Grill, right? But often the question is, when's the turnaround? We had a downtrend for a lot of the year, but right now it's like, well, look, we hit a low. Oh, we have a higher low. Looks like we're establishing a higher low now. Higher high. We're above our 20 and our 50-day moving average. We had that moving average cross. I think for a lot of traders, they'd say, hey, that bearish, lousy performance for 2025, it looks like maybe it's turned a corner. So there's a possibility. Now, let me just finish up with this. We did 2 weeks ago, we did a trade on what's it? Double diagonal. Let me go to my diagonals. I can't remember what did we do? Oh, UNH. That's right, UNH. What's a double diagonal? Well, if you want, go back to our class 2 weeks ago on this webcast and we go through it in depth. But it's a neutral type trade. Okay, neutral type trade. Hey, we're doing okay on it. It's neutral. The stock, look, our short options, which would be out of the money, are 330, 340. So we'd want the stock to kind of stay in the 330 to 340 range. And right now it's at 338. Doing pretty good. Okay. Here's UNH. Right. And you can see, hey, it's done kind of what we wanted. Today probably wasn't a great day to it. I didn't see what our PL day was on this. Yeah, it's a little worse today than it was before. But what you can always do is go to your Analyze tab, go to UNH, or whatever stock you're looking at, and say, well, look, my peak is about I can make a little less than $600 would be our max gain. We're not striving for max gain here. Number one, we're not going to hold it all the way to expiration. Number two, it can be hard to achieve that max gain. Okay. But if we can get a third of the max gain or something like that, that's great. Well, we're at $176 on this right now. That's probably enough. We're at 7 days. We got to do something with it. So we either need to roll it or exit. I'm just going to get out of the whole shebang here at this point, though. Okay. And so I'm going to do that. I'm going to get out of this trade. Now, if you have a 4-leg option, you may not get out of the whole thing at once. You may get out of, you can get out of one spread at a time or something like that if you want. You can highlight the ones you want to exit and create a closing order, sell it, confirm and send that, and then you can get out of the other elements, highlight them, create a closing order, get out of it, and then we're out of the trade and you book the, hopefully profit. Now, okay, let me do one question and then wrap. Question was, can we close just certain legs of it? Yeah, you can close certain legs, but if you just get out of, you're changing the trade, right? It's no longer a double diagonal at that point. It's a completely different trade at that point. We would be left with a long call and a long put, which is a strangle trade at that point. Okay, so that's at that point it's no longer a neutral trade. That'd be a trade hoping for volatility on that. Okay, so just realize pros and cons. It's a new trade. Everybody, thank you for joining me today. What did we do? We talked about synthetics, long synthetics primarily. Pros and cons. We gave you examples, how to place the trade. We talked a little bit more. We talked about management, talked about Greeks, and in upcoming weeks in our managing options portfolio, and this one perhaps as well, we'll look at managing as well. Thank you for joining me. Thanks, James, for helping me out in the chat. Coming up next, we've got market and sector analysis. Everybody have a wonderful rest of the day and a wonderful 2026. Bye-bye, everybody.